is good deflation for those companies that are on the forefront of these new technologies. It might be bad deflation for companies that are going to be disrupted. And if they're being disrupted, they'll be forced into cutting prices as well. So we think we're going into a much more deflationary world than I think many economists and strategists would suggest. So that's the cost dynamic. And I gave you the productivity dynamic around agentic AI, smart contracts, API to API transactions, including very small transactions. So, and yes, I think we, as you know, we were the cornerstone investor in Circle. So we've been watching the stablecoin movement, which is exploding. And of course, again, most of that is happening on Ethereum.
Hey guys, welcome to Everyday Finance. Panic grips the markets over the Fed's every move. Bitcoin continues to climb in a way we've never seen before. That's the message from Ark Invest CEO Cathie Wood. She sees the economy flashing, warning signs, job growth slowing, housing markets weakening, and consumers pulling back. Inflation is easing, making rate cuts more likely, but instead of fueling strength in traditional assets, momentum is fading. Its steady rise, even as the broader market loses ground, signals something much deeper than a short-term trade. Wood believes capital is deliberately shifting away from a financial system that struggles under pressure into an asset designed to endure uncertainty. In her view, Bitcoin is quietly stepping into the role that traditional safe havens were once trusted to hold, but can no longer sustain.
Well, I think it was interesting in the Fed vote today, there were two dissents, and we have not had two dissents since 1993. And I remember those because I was in the business back then as well. And I think that's very important symbolically because Chairman Powell has wanted unanimity. And so now we've had a break. And part of it is because Chairman Powell's term is up in May of next year. And maybe the two governors dissenting want a shot at that position. You never know. You never know. But maybe it is because the two governors, and I haven't gone through all of the notes yet, the two governors are seeing evidence of housing relapsing here and prices in many areas not responding to tariff increases and seeing that, well, wait a minute, maybe the surprise here in the next 6 months is going to be much lower inflation. And we've had a few employment reports that they have something for everyone, you know, some strength, some weakness. But I think what's beginning to concern a lot of people is that the unemployment rate for new college graduates is going up. And that's because entry-level positions are being subsumed in many cases by automation, especially AI. And so I think they're looking at this as a potential concern out there. We have been saying for quite some time that the economy has been in a rolling recession. When the Fed jacked rates up 22-fold in little more than a year's time, one sector after another began to give way, starting with housing. Housing, by many measures, is down 35% still from the peak. And we're seeing some metrics take another step function down. So I think that has some people concerned. I think the housing inflation numbers are going to come down. They're already, the monthly numbers that we get from various sources are showing declines. Year over year, they're not declining, except for maybe median existing home sales. But we do think that one of the solutions to the affordability crisis, if sellers really want their homes to move, they're going to cut their prices. And because that is if interest rates don't come down. And if they do cut prices, then the big surprise in the latter part of this year is how low inflation is going to go. And there's a big lag between the time home prices fall and they get into the statistics and leave the statistics as well. So this is going to be with us for quite some time. So I think we've been saying we believe that thanks to certainty now, more certainty about tariffs, tax policy, government spending, and regulation or deregulation, that we're getting ready to move from this rolling recession into a much stronger than expected recovery. In the next, I'll say 6 to 9 months, it will become obvious. With productivity, one of the biggest surprises, it's already strong given the slow growth rates in the economy. I think year over year, it's still up above 2%. But we think it's going much higher thanks to all of the technologies around which we have centered our research. So robotics, energy storage, AI, very importantly, blockchain technology, obviously important here, and what we call multi-omic sequencing in the life science space. All of those innovations are incredibly deflationary. And the best example probably is AI. AI training costs are dropping 75% per year. AI inference costs, so the cost to get an answer for as we're typing into ChatGPT or Grok, my preferred right now is Grok, those costs are dropping anywhere from 85 to, in China, we've gotten a statistic, 98% per year. So when you cut the cost of something, you get a lot more of it. So we think this is good deflation. This is not deflation like 08, 09. That was very bad deflation. This is good deflation for those companies that are on the forefront of these new technologies. It might be bad deflation for companies that are going to be disrupted. And if they're being disrupted, they'll be forced into cutting prices as well. So we think we're going into a much more deflationary world than I think many economists and strategists would suggest.
Cathie Wood sees interest rates as one of the biggest uncertainties weighing on the markets right now. Jerome Powell may continue with his hawkish tone, but the data suggests otherwise. Investors are already pricing in rate cuts, and pressure is building inside the Fed itself. For the first time since 1993, two members openly dissented, signaling fractures within the central bank. At the same time, recession fears still hang over the economy as growth slows and confidence wavers. Yet Wood interprets this moment differently. Instead of collapse, she sees the foundation for the next recovery, one that won't be fueled by cheap money or speculation, but by real gains in productivity. In her view, innovation and efficiency will drive the next phase of growth. And the shift we're seeing now is only the beginning.
The regulatory environment is very important here. We've gone from a hostile regulatory regime under Gensler at the SEC to a very, very friendly regime now, with legislation guiding regulators instead of regulation through enforcement, which was forcing innovation off U.S. shores to other countries. Now that's changing aggressively, especially appointing David Sachs, the czar for both crypto and AI, and this concept of agentic AI coming into view, where we will have our AI do all the walking and working and talking for us, up to a point, right? Because of agentic AI. And we need smart contracts because these agentic AI, our AI agents or assistants, are going to be interacting with sites, maybe like CoinDesk, that, where we'll need to pay some money for something, one thing or another. And these are going to be automated smart contracts. Well, agentic AI is going to make that happen. So this is the convergence of AI and blockchain technology. But before that, what we're also seeing is a revolution in financial services. Thanks to the green light from regulators, more financial services companies are moving into the blockchain world because they realize it's much lower costs. So as I explain to our clients what's going on here, I like to back up because I remember this time very well. In the early 90s, late 80s, early 90s, when developers were first working on the internet, there was no idea that financial services or commerce would take place on the internet. And therefore, there was no payments layer. Now, thanks to blockchain technology, we have the payments layer. Over the last 30, 40 years, because we didn't have the payments layer, we needed to, and because financial services and commerce did migrate onto the internet in a very big way, the traditional world had to mitigate the risk of putting credit cards online and, trying to use traditional financial tools in this internet world. And all of the intermediaries involved have been taking anywhere from 2 to 3.5% out of each transaction, paid for mitigating the risk. We can probably drop that, and that's a tax on the system, right? We can drop that tax from 3.5%. These are US numbers. In Nigeria, the numbers would be 20% or more, right? Drop that tax from 3.5% to maybe 1%. And, the financial services world is huge. We think it's going to be a $250 trillion assets under management world in 5 years. So if you're talking about those kinds of numbers, taking 2 to 2.5% out of, or lowering the tax by 2 to 2.5%, will lower the friction in the market and increase the efficiency. So that's the cost dynamic. And I gave you the productivity dynamic around agentic AI, smart contracts, API to API transactions, including very small transactions. Yes, we have been watching carefully who is signing on to what protocol as they begin to develop their digital asset strategies. So, well, first we saw Coinbase, for its layer 2 base, chose Ethereum. More recently, we saw Robinhood, for the layer 2 that it is evolving, also building on top of Ethereum. We had a thesis that Ethereum was going to be the institutional protocol. I know that Solana was doing much better. Solana had a massive run relative to Ether. And so many people were challenging that notion. And yet we're seeing the votes being placed. And it makes sense. Ethereum, while it might be higher cost and a little slower, it's more decentralized and therefore more secure. Solana, we think, is probably going to be the winner in more consumer-facing applications. And it was very, very difficult for us to gain a position in our ETFs with good exposure to Ether. There are all kinds of problems when 40 Act funds buy another fund, another ETF to gain exposure. There are tax issues. There are fee issues, fees upon fee issues. There's something called, and this is a tax issue, bad income. If the profits associated with something generating bad income, bad doesn't mean evil at all. It just means it's a tax term. If those profits, gross profits, this is gross, there's no netting here. if those gross profits are more than 10% of the total profits generated in a year of a fund, the entire fund can be shut down. The tax benefit, you'll basically you'll lose a lot of tax benefits, and you'll be subjecting the fund to a great number of fines, if not actual shutting down. So we can't take those risks. And as you can tell, I'm not deep into tax law, and I'm not going to be able to explain exactly what, who, what, when, where, why, and how. I just listen to our trading team, our compliance team, our finance team, and I say, okay, I can't go there. It's just, I can't do it. So this is the first time we've been able to gain a solid position in Ether. And, sure, it comes at a premium, but what's different from Bitcoin treasuries, like MicroStrategy, now Strategy, is there's just more utility that these Ether treasuries can offer, staking being one of the most important ones. The ETFs, at least not yet, do not, the Ether ETFs are not allowed to stake. Mm-hmm. So, and yes, I think we, as you know, we were the cornerstone investor in Circle. So we've been watching the stablecoin movement, which is exploding. And of course, again, most of that is happening on Ethereum.
Cathie Wood argues the Federal Reserve has held policy too tight for too long, but she expects a major shift is close. With inflation continuing to ease and signs of slowing across the economy, she sees a September rate cut as likely, followed by more easing into the end of the year. That pivot could breathe new life into sectors like housing and capital spending areas with powerful multiplier effects that can accelerate growth once rates fall. At the same time, Bitcoin continues to climb, even against traditional safe havens like gold. Wood views this as more than coincidence. It reflects a broader risk-on rotation, where capital is shifting toward assets built for long-term growth. If the U.S. can sidestep a deep recession and productivity begins to surge, she believes Bitcoin, along with other innovation-driven assets, could be among the biggest beneficiaries. For Wood, the current fear-dominating markets is actually a bullish signal, the classic wall of worry that often sets the stage for a larger breakout. Rather than a moment of collapse, she interprets this period as the setup for the next powerful leg higher.